Welcome to This Explainer. Today, we're doing something really exciting. We're mapping out the intellectual fault lines for the next decade of investing. You see, the next 10 years are going to be radically different from the last 40, and to navigate them, we basically need an entirely new mental model. We're going to build that model by looking at the historic, ongoing debates between hard money skeptics like James Grant, productive asset champions like Warren Buffett, and modern institutional macroeconomists. Here's our roadmap for today. We'll explore 4 plausible macroeconomic scenarios, evaluate 4 major asset classes within each one, stress test them against some pretty extreme tail risks, and then wrap up with a regime-sensitive allocation framework.
All right, let's jump right into Section 1, the 4 macro regimes.
So the next 10 years, they are incredibly path-dependent. Thanks to massive debt levels, shifting demographics, and the sudden return of inflation volatility, there really is no single magic bullet asset anymore. Instead, we can kind of map out the future into 4 distinct economic regimes. And keep in mind, these aren't mutually exclusive. Economies like the US or the UK could easily cycle through a few of these sequentially over the next decade. To protect our capital, we literally have to know how to operate inside every single one of them.
Moving right along to Section 2, financial repression and stagnation.
Let's kick things off with the exact environment hard money skeptics, like James Grant, have been warning us about for decades: financial repression. In this scenario, governments basically find themselves in a corner. They just can't tolerate the crushing interest costs on their massive debts. So what happens? Central banks step in. They prioritize debt sustainability over price stability. Basically, they let inflation run a bit hot while artificially capping bond yields, which silently eats away at your purchasing power over time.
Now, this environment perfectly highlights that classic decades-long debate between James Grant and Warren Buffett. In a financially repressed world, gold absolutely shines. It's the cleanest monetary hedge out there because, well, it carries zero counterparty risk and sits entirely outside fiat manipulation. But Buffett's counterargument is still a massive hurdle. He points out that gold is fundamentally non-productive. It doesn't yield any cash flow, it doesn't compound, it's really just a rock that preserves relative scarcity.
So you might be wondering, how do traditional nominal bonds hold up here? Well, it's a nightmare. James Grant famously called long-term bonds return-free risk in this environment. Because inflation just continuously chews away at their fixed payouts, they suffer severe real value losses. They basically act as a slow poison for your purchasing power. Instead, short-duration inflation-linked bonds, things like TIPS, become the mathematically superior tool. They protect your real return without putting you through the wild roller coaster of gold's volatility.
Now, standing in stark contrast to repression is secular stagnation. This is a regime heavily championed by macroeconomics like Gary Shilling and Larry Summers. In this world, we see sluggish growth alongside stable target-level inflation. The key difference here is that low interest rates aren't the result of central bank manipulation. Actually, they're just the natural equilibrium of an aging society dealing with excess savings and really weak demand.
Believe it or not, this is actually the absolute strongest regime for long nominal bonds. If inflation stays perfectly tame and growth just sort of sputters, those long bonds once again offer fantastic capital gains and act as essential recession insurance. On the flip side, gold lags terribly in this environment, unless real rates drop deeply into the negative. If institutions hold on to their credibility and real yields stay positive, productive assets and bonds will run circles around inert metals.
All right, Section 3, productivity and fiscal stress.
Let's completely flip the script and look at 2 radically different extremes, starting with a massive technology-driven productivity boom. This is a highly optimistic scenario where technological gains completely offset demand. Think back to the late 1990s tech expansion. We're talking about AI, automation, and energy innovation creating a huge wave of disinflationary abundance. Supply growth simply overwhelms demand, making everything structurally cheaper. In this world, equities absolutely dominate. The massive productivity boosts support incredible margin expansion and real wage growth, all without triggering an inflation spiral. This is literally the world where Warren Buffett's philosophy reigns supreme. Meanwhile, gold, it faces its absolute weakest regime here. Because when institutional confidence is soaring and capital is incredibly productive, paying money to store blocks of inert metal suddenly becomes a very, very expensive insurance policy.
But there is a dark opposite to that productivity boom, and it's acute fiscal stress. This is that low probability but extremely high impact nightmare for sovereign debt. Think of the 2022 UK gilt crisis, but on a much, much larger scale.
It's the kind of chaos triggered by failed debt auctions, extreme political paralysis, and a sudden rapid evaporation of public trust in fiat institutions.
Here's the really crucial point to understand about defensive assets in this stress scenario. While gold performs exceptionally well when sovereign trust vanishes, even inflation-linked sovereign bonds become incredibly unstable. Why? Because at the end of the day, they still rely on government credibility. If the market suddenly starts doubting a government's ability to pay, or even questions the accuracy of its inflation statistics, those supposedly safe index-linked bonds can get extremely volatile.
Moving to Section 4, Assessing Tail Risks. So what happens when we step outside these central scenarios and really test our portfolios against the extremes? We're looking at 5 major tail risks: a 1930s-style deflationary debt collapse, a 1970s-style persistent stagflation, a massive sovereign pension crisis, an absolute AI productivity explosion, or at the very extreme, a complete monetary regime reset, like coordinated inflation restructuring or severe capital controls. These outlier events have the power to just completely upend conventional asset allocation models.
When these extreme shocks actually hit, all your standard market correlations just break down. A deflationary collapse, you absolutely need long nominal bonds to survive that. But a 1970s-style stagflation or a monetary reset, those require heavy allocations to gold and short linkers. Equities will get crushed in a sovereign accident, but they'll yield extraordinary returns during an AI boom. As you start to really evaluate these scenarios, a very harsh reality becomes clear. Literally, no single asset survives every tail risk.
Take a look at this quote from Warren Buffett from back in 2021. It perfectly encapsulates this entire paradigm shift. It's fascinating because it illustrates how even the ultimate champion of productive assets recognizes the acute danger of fixed income when tail risks like persistent inflation are looming. The starting valuations of debt simply don't offer that cozy margin of safety that they did 40 years ago.
Finally, Section 5, Strategic Asset Allocation Summary.
So how do we actually pull all of this together into a cohesive strategy? Well, the most critical variable to grasp is that the remarkably stable inflation of the 1982 to 2020 bond bull market is officially gone. During that era, nominal bonds were basically a magic bullet. They effortlessly solved both growth shocks and inflation shocks simultaneously. Today, that mathematical reality just no longer exists. When we build this into an actual allocation framework, a stark truth emerges. You simply cannot afford to be all gold or all bonds. Every single asset uniquely hedges a specific macroeconomic regime. Gold is your hedge against institutional distrust. Short linkers mechanically hedge against inflation. Equities are there to capture productive growth, and nominal bonds provide vital insurance against disinflationary recessions.
The core takeaway from analyzing decades of debate between financial giants is that standard asset correlation just doesn't cut it anymore. Your portfolio has to be explicitly diversified against regimes, not just individual assets. You're no longer just balancing stocks and bonds. You're actively balancing the risk of inflation versus deflation and institutional trust versus total institutional collapse.
Ultimately, the next 10 years of investing are going to be defined by one massive unresolved tension. It's a huge tug-of-war. Will historically high debt levels force central banks to artificially suppress rates, thereby creating persistent, grinding inflation? Or will that same crushing debt burden suffocate private demand, ultimately dragging us down into structural disinflation?
By aligning your capital with this regime-sensitive logic, you're acknowledging a profound reality. No single asset class will dominate the future. True, robust wealth protection requires systematically holding and strategically deploying all 4 tools: equities, nominal bonds, short linkers, and gold. The intellectual fault lines for the next decade have been clearly drawn, and survival will absolutely belong to those who are prepared for the entire matrix.